Hello everybody, welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and today I am going to be sifting through a little less than 50 stocks and doing a quick analysis on them to show people how I sift through stocks quickly and kind of throw out the stocks that either aren't a good fit for my strategies or maybe there's just not like enough data. And I've done a couple videos before this using the same method, and people really enjoyed it. So I'm going to be sifting through the S&P 400 Midcap index, and we're going to do stocks that start with the letters B and C. I've done a previous video on the letters that started with an A, and I have a playlist where you can watch all these in a row. It's been a couple months since I've done one of these, and I'm gonna try to do at least one like every month, and we'll just keep kind of going through. Kind of the goal of this is just to show how if you know the metrics that you're looking for, the basic ones that are required to do whatever kind of analysis that you are good at doing and that want to do, you're looking for stocks that kind of fit the profile that are worth doing more research on, are worth tracking, are worth running the numbers more clearly on them. And this is really kind of how I do it. So I have about 5 different strategies that I use. I have what I call a full cycle strategy. Usually that's an earnings and earnings growth based strategy where I prefer to have at least one recession's worth of data. That's probably my core strategy. And then I have a deep cyclical strategy for businesses whose earnings are very cyclical. They go up and down a lot, the earnings do. I have what I call a profit growth strategy, which is my earlier stage growth strategy. I don't make videos on YouTube, but if you join the Full Cyclical Investors Club service over on Seeking Alpha, then I explain the whole strategy and everything. But for these would be, because my full cycle strategy requires a pretty long history, this strategy can pick up some stocks where there isn't as much history, but maybe has the potential for a really long-term big returns, like 5x, 10x over, say, like 10 or 15 years. So that's kind of what that strategy looks for. And then I have a REIT strategy, and then I have a dividend strategy. So in practice, usually stocks that are in the dividend strategy also fit the full cycle earnings strategy. But every now and then there's one that works better as a dividend analysis than it does in earnings analysis. So I'll include that as well. So, and then there's kind of 3 categories of stocks that end up being kind of what I avoid. One of them are the ones I don't have enough data on. They don't have a long enough history. I usually use history as my primary guide for the future, really with all my strategies. Although I have to make adjustments sometimes when there's not very much history. But if it doesn't fit in like the growth strategy and there's not enough history, then I just move on. I just put it in the not enough data. The other one is not high enough quality. I want all the stocks that I buy to have a long-term earnings growth that is faster than inflation. So I don't buy any stocks basically unless there's a history of that being the case, or I have a good reason to think it will be the case. But most of the time it's based on history. When I'm sifting through, it's almost always based on history. And then some of them are just kind of too hard. Maybe their patterns, their historical patterns are just kind of chaotic. Maybe they're in an industry that doesn't fit well with my particular strategies. There can be a variety of other reasons why something might just be a little bit too hard. And so if the stock kind of goes into one of those 3 categories, if it doesn't fit into one of my potential strategies that I might use to buy the stock. So what I'm going to do is I'm going to sift through all the S&P 400 midcap stocks that start with B and C, and I'm just going to place them in one of these 8 kind of, either they'll fit into one of my 5 strategies, or they'll fit in one of the 3 categories of the reasons why they don't go in. And then at the end, we'll kind of look and see kind of where everything falls. Now, if I do this for the S&P 500, it's a very high quality index. So it would really skew things a little too positively, I think. in terms of what's out there in the wider market. So it's much higher quality than almost any other index. And then if I went to small caps, it would kind of be the opposite, where a very low quality, maybe 2 out of 100 stocks might really fit what I'm looking for. Certainly no more than 1 out of 10. And so the S&P Midcap kind of is ideal to do something like this because it gives a pretty balanced view of the types of stocks that can be kind of rising, growing, and then other stocks that may be falling, and then some that kind of just always stay in the middle in terms of what the business is doing. So with that, let's get started. I'm going to use fast graphs for this. This is a great tool. This is my favorite tool for doing what I'm about to do now. And I do have a 25% off affiliate link down in the description if you're interested in trying out fast graphs. But I think this and like earnings-based stuff or earnings-based analysis are the primary reasons that I use fast graphs. Because I can literally sift through dozens and dozens of stocks really quickly, and on that initial run through, I can eliminate like half of them usually right away for my strategies. So with that, let's get started with Brunswick. So when I look at Brunswick, I see deep cyclical earnings that have fallen deeply during a recession, which is one would expect, but they also recovered within about 5 years, which is what I would want. And now it looks like we're starting another down cycle, but this looks like it would be a good deep cyclical candidate. So I'll mark one down for cyclical. I would definitely check in on this because look, you can see if you buy at the bottom and you hold up here, you get a 27% CAGR. So the potential's there during another downturn where you could do really well, even during COVID. I'll just briefly do this. I'm not going to do this with everyone, but I mean, really good return. So yeah, definitely interested in tracking that as a cyclical. All right, Brinks, BCO. So, okay, so this looks pretty good. This is right on the borderline of being kind of a cyclical. It does look a little weak, honestly. The earnings growth looks pretty weak across time, but it does look like it's picking up lately. So I would probably track this since we didn't have another big earnings decline. I'd probably go ahead and track this as like a full cycle stock, but I'm guessing the earnings growth might not be what I want, although it has been improving. So yeah, full cycle, definitely I would take a look at it. Belden, BDC. I'm going to try to pick up the pace here a little bit. Okay, another deep cyclical, good recovery, really deep. I mean, you don't want to be buying this one like right now. You want to buy it during one of these down cycles. What do they do? Electrical components. Yeah, I mean, I think as a deep cyclical, you'd want to take a look at it. They do have some debt, so you'd want to make sure you're buying it really low. But I could track that one probably. Let's see next. It's like 3 in a row. I hardly ever get 3 in a row. Berry, BERY. Okay, so for these guys, let me check something real quick. Yeah, it's a little lumpier on basic earnings. Okay, so they don't have good recession data. What do they do? Metal and glass containers. Okay, they have a lot of debt here, and I don't have recession data. That one would be probably no data for me, not enough data. Because when you have that much debt, these guys could get really slammed during a recession. And we don't want to own something like that too soon. We want to have a gauge, basically, like a historical gauge to see how they did during past recessions. BHF. Okay, not enough data for these guys. So let's see. And it's a financial, so you really want... For financials, I want data from 2008 for sure. BJ's Warehouse. Again, not enough data. And it's retail. You know, if this was like a software company or something, I might look at this earnings growth and consider it for the growth thing. But for retail, that's not likely to be something that I want. BKH. Okay, so we have recession data. It's pretty, they did have a deep decline here. Let's take a look. 34% though, so that's not really a deep cyclical. That's just kind of moderate and normal cyclicality you would expect during a downturn. It is a utility. They have a lot of debt. But yeah, I mean, I could track that as a full cycle stock for sure. So I'll put that one down in my full cycle category. Top build, BLD. Probably not enough data for me. They're in home building. They don't have 2008 data, so that would be not enough data because they could get really slammed during a recession potentially, especially with interest rates where they are right now. Blackbaud, BLKB. These guys might have a buyout offer on the table. Thought I saw something the other day, but I could be wrong. Yeah, I mean, I can track that as a full cycle stock. Plenty of history. We have decent earnings growth. Every now and then it's choppy, but worth taking a closer look at. BRBR. Probably not enough data here. Yeah, personal care products that's just starting. That's going to be not enough data for me. Bruker, BRKR. All right, so yeah, this one looks like it could definitely work as a full cycle stock. We have plenty of data, pretty decent earnings growth on the surface here, so maybe. Let's see, BRX. This looks like a REIT, so I'll just put that one in the REIT category. One thing I will, hold on, what I say BRX? One thing with REITs, I like to have at least like 5 years of data. So there is 5 years of data here, but you can see that it really the price hasn't done much over this time period. So really, even though it is a REIT, I wouldn't actually consider this one high enough quality for my REIT strategy. So it actually go not enough quality. Because I want a rising REIT pattern, basically. There's more to it than that, but that's the basic thing. BURL, Burlington. Burlington Stores. I wonder if this is Burlington Coat Factory. Could be. Is this retail? Yeah. So I would want more data for this one. I would want the real recession data, not just COVID. This doesn't mean too much. And now we already have a weird decline in 2023 after they recovered. That would just be, yeah, not enough data. I want recession data for that one. Okay, BWXT. Okay, so we have back to 2011. Earnings look pretty steady. The valuation looks a little steep right now, given where earnings growth is expected to do. I wonder what these guys do. Oh, defense. Okay. Yeah, probably not enough data, honestly. I mean, if they look kind of cheap, I might consider it, but it doesn't really look particularly cheap, so I would probably wait for more data. I wouldn't feel like I needed to chase anything like that. BYD. But it might be okay for some folks if the price was cheaper. It's just that there's other aerospace and defense that I feel more comfortable with. So this is one where we have a deep cyclical pattern, right? But the cycle is so long that it doesn't really have, it's not predictable enough. I would say, I'm going to say too hard category for this one, but it's kind of, I know that it doesn't have the quality that I want, honestly, but we can just put it in the too hard category. Because maybe somebody can make a case that, you know, the past isn't the same as the future. There might be a reason why it's a good buy now that I just can't figure out. So these guys would definitely go into the full cycle category, and I would definitely track that. You can see Solid long-term earnings growth. So that looks pretty good. Cadence Bank. So this is going to be a financial. So we definitely want 2008 data, which we have. Okay, so big decline in earnings. That would make it a cyclical. So this right here would be very concerning. This 2023, I would probably avoid it just because of this downturn. I don't know what caused it. I don't know if there's a good reason for it. It took them quite a while to recover from 2008 as well. So I would say this is probably not high enough quality because a lot of these regional banks trade similarly, so I don't have any reason to buy the ones that I don't think are the very highest quality. Avis Budget. This is very weird. So this is a deep cyclical. Looks like we're starting a down cycle, but it's just a little wonky, and it's a car rental business. We saw Hertz, I think, if they didn't go bankrupt, they came close to it. I'm just going to say this one probably isn't high enough quality for me to really have. The thing is, you have to buy these when they're really cheap in a down cycle, like down here when it's under $1 per share, right? You have to have the guts to come in and buy it. And when that happens, things are going to be really horrible. And I don't think I would have enough confidence to go in and buy it when things look really horrible. I mean, if you can do that, you can make pretty good money usually, like 50 CAGR. But chances are they were probably teetering on the edge at that point in time. So even though in retrospect it worked out okay that time, it might not work out okay the next time. I don't like to take that much risk. Casey's General Store. I was just at Casey's yesterday. Let's see. So Casey's looks pretty good. They had a little kind of decline here in the middle of, I'm not sure what was going on. Maybe they made acquisition or something. But the overall pattern looks good. So I would definitely track this one, even though it looks expensive right now. Okay. Commerce Bank Shares, CBSH. Again, we want to see a strong pattern with any kind of bank that we're looking at, and we want it to go back to 2008. I don't know. Oh, they have all these stock splits. They must have a weird kind of policy where they split their stock every year or something. So yeah, I mean, this doesn't look too bad. Yeah, I'd be willing to follow this one as a full cycle stock, even though it's kind of weird that they do these stock splits. It looks like they're pretty sound. They have a pretty sound history. So Cabot, CBT. Okay, deep cyclical, good recovery, no growth during this time period, but we do eventually, in another down cycle, but we do eventually get growth. Yeah, I mean, I think I could put this one in the cyclical category and take a look at it. There's some opportunity there if you buy it cheap enough, but you want to buy it when it's like down here, or at least that's when I would want to buy it. So I wouldn't be buying it now, but it's worth tracking. Chemical. I think these guys are chemical company. Yeah, chemicals. Not really enough data for a chemical company. Usually they're deep cyclical. I want to have a longer term history to help guide my entry points. So yeah, I would want a longer history. Let's see. Crown Holdings, CCK. Okay, this one looks pretty solid. I'm not sure why they didn't have hardly any earnings back here. Okay, metal and glass containers. Yeah, I would be willing to track that with my full cycle strategy. Looks like they're in a down cycle right now. CDP, another real estate. Defense properties. Maybe they do something for the government. So this is the type of thing this is where quality really comes in. I mean, even if you didn't pick up here at the peak and you just kind of picked here or something, I don't know. You can just tell the overall trend is just not good returns. So that's not what I want. I want better returns. I don't know if these guys are technically a REIT. Oh yeah, an office REIT. Yeah, like the worst kind right now. But the pattern all along, like even if we went back before COVID, look, I want a rising pattern with my REITs. So this wouldn't be high enough quality for me. All right, where are we at here? Celsius. So this is one I know is going to go into the growth strategy because I've been following it. I haven't bought it yet. But this is our first, growth stock where I would, even though they traded a long time back here, if you shorten it up, really it's this a little before the pandemic when they started to grow finally and get some earnings here. And now it's just a question of, I don't know if they can grow that fast. 93 PE is a little expensive. This is one I definitely track and I probably would buy. This basic pattern here where they're not earning much and then they start finally earning money and they're growing fast. That's a good, like a setup for a growth stock that I would buy, that I would be willing to pay up for. I wouldn't probably pay a 90 PE most of the time, but definitely worth tracking that one. Frost Bank. Okay, I am familiar with these guys because I do track these. And this might be, I haven't looked at it for a while, so this would be more of a regional bank that you would see. They didn't get completely crushed during the Great Recession. They kept earnings rising steadily, right? Even when interest rates were kind of low. And then they kind of picked up, and of course COVID kind of sucked, but the overall trend is bottom right, right to left going up. That's what we want to see for earnings. So yeah, I would track this one. And you contrast that with some of the other ones, the other regional banks, and you can kind of see why, to me, it doesn't make sense to take a chance on any of the riskier ones to try to just, because they trade pretty similarly, honestly, most of the time. Carlisle is just too, I would say, too hard. There's not enough data either, but the earnings just fluctuate too much for me to try to gauge what they could do or not do over time. CGNX. So now this is one I would probably say is too hard too. They just have these periods where like earnings don't really do a whole bunch. They had a kind of a bump here and then nothing, and then before that it wasn't much, and now they're coming down. So like this one's just too hard, I would say. All right, how far down are we? Churchill Downs. Somebody asked, I think I made a video on Patreon for this one for someone a while back. Really pretty solid. I mean, COVID obviously sucked. But I want to say these guys are maybe have like some casinos or something too, if I remember right. But yeah, you could definitely, this isn't a bad pattern to take a look at, but they can be a little bit unpredictable. So I probably wouldn't personally buy it, but you can definitely see that in the right conditions, if you don't pay too much for it, you can do pretty well. A 25% CAGR over the past like 10 years or so is pretty awesome. I don't know if they can keep doing that, but it might be worth taking a look at. CHE. So these guys look very solid. Definitely track that on full cycle earnings. Let's see, Choice Hotels. I forget which one are the Choice brands. If those are like the Days Inn and Quinta Inn. I don't remember for sure. It might be. What's earnings growth? 9%, and that's these couple years. And then that's, you could track it. I'd probably be more interested in like Marriott or Hilton or something like that, but it's, it might work if you got it cheap enough. All right, Chesapeake Energy, CHK. I'm actually finding a lot more that look pretty good right now. So not enough data on this one. Chord Energy. I actually have not heard of them before. What was it? CHRD. Okay. And there's not enough data there. All right. Champion X, CHX. Not enough data for that one either. Now we're getting more into what I'm used to seeing in mid-caps. CIEN. This one's just a little too unpredictable. This is a really deep downturn, and it was kind of really down before. It looks like earnings have kind of come around, even though they're very choppy still. What do these guys do? Communication equipment. That can be very cyclical usually. So this is probably a cyclical that doesn't have the type of cyclical pattern that I would actually like to see. So I would put this one in the too hard category for me personally. I think it's going to be hard to predict what happens with these guys over the next few years. All right. CIVI. So that's interesting. I wonder if this is like an oil company. Oh, hey, it is. What do you know? And they have a lot of debt. So this one just wouldn't be high enough quality for me. All right, Cleveland Cliffs. I want to say these guys might do steel or something along those lines. I'm trying to remember. Steel. Hey, I was right. Decent amount of debt. You can see this huge upcycle, gigantically huge earnings and price cycles. But you can see they've never really recovered back to where they were, you know, during 2008 to 2012 or even 2013. So really the new pattern is kind of what we have here. Yeah, I'm going to put this one in the too hard category for me. I think if a person got it right, they could do well probably if they bought it at the right time during, like if somebody bought it during this COVID decline, you know, they could probably have done pretty well, right? Yeah, 300% return. But it can be very hard to predict exactly how long those recoveries will take, how deeply you need to wait until you buy it. So yeah, just a little bit too hard for me. There might be some situations where I'd be willing to step in. Given the geopolitical things that are going right now, that might be one where a person could take a little bit more of a chance on if it was cheap enough. But for now, I'm just going to say it's too hard. Yeah, I'm going to put this one in the too hard category too. Yeah, because you have these really long, slow declines. I mean, I know that they've kind of improved lately, but COVID is such an outlying year. It would take deeper work to kind of establish what to expect from these guys, and that's not usually the type of analysis that I do. But if I got really bored and desperate and had a bunch of cash, you know, I might really dig in and see what was going on with kind of the new trend and whether it's sustainable. So it could work for folks, but just a little too hard for me, at least right now. CMC. Okay, deep down cycle and pretty long recovery here. Really, it took COVID to recover the 2008 highs. It's another steal. Okay. And then we have this boom, and then now prices are coming down. So yeah, this is going to be another too hard one, but if somebody put the work in, maybe they could. Personally, I wouldn't buy something like this during an up. I mean, see how good it looked here before the Great Recession. Well, that's pretty much how good it looks right now. And so if there is a recession, there's just a lot of danger there. So for me, I would want to buy it during a down cycle. And again, like if you bought during this down cycle, you probably wouldn't have done well. That's not too bad. I mean, it's probably about the same as the rest of the market did. It's very borderline. I'm just going to put it in the too hard category for me right now, unless a person really wanted to focus on some steel businesses. CNM. Core and main, not enough data for me on this one. Let me see what they do for the growth strategy maybe. Trading company, 3 years worth of data. I'm going to say not enough data. CNO, which is a financial. This is just a little too long recovery time. The stock price, I mean, you would have done well if you picked the bottom on this, but I'm going to put this one in the too hard category for me. I mean, if you look at once they recovered from here, I mean, stock price wise, it hasn't returned much. So I think they got that initial recovery, and if a person was willing to really take a chance down at the bottom, they would have done extraordinarily well. But I think most of that easy money is probably gone. And it's a health insurance. So insurance companies, I prefer not to see too many of these. They're just really hard to predict like what the down cycles will be like. And that's probably why it's trading at such a cheap multiple. So yeah, that one's just, it's a little too hard for me, I think. Okay. So CNX. Maybe. There we go. CNX. Okay, this looks like oil and gas probably. Yep. Decent amount of debt. This is very typical oil and gas pattern. I would say it's not high enough quality for me. I mean, to go through a huge down cycle, like even if you would have bought here, you still would have been underwater at the beginning of COVID. It does look like things have stabilized, but like I own Oxy and Devon, and I probably would just go that way instead of going with something like CNX. CNXC. Concentrix. I think this is software maybe. Oh, data processing outsourced services. I'm basically avoiding all data processing stuff and outsourced services because of AI. So I would just put this one in too hard for now. And there's not enough data either. So it could go either. It could go either way. Even if it looked good, it didn't look like there was enough data for my strategies. Coherent, COHR. Okay, so now this one looks pretty interesting until we get to this current down cycle here. That 2011 was kind of a one-off year. Oh, they split stock. Maybe they had some kind of M&A. And then really kind of a long recovery period. What do these guys do? Electrical components again. Decent amount of debt. I don't think this is high enough quality for me. And we can kind of see the weakness coming right now. But it's borderline. If somebody wanted to do more deeper research and take a chance, maybe it could work out pretty decently. Just, I'm not quite there yet. Okay, Coca-Cola, I don't know what's going on with this expected earnings decline this year. This could, who knows, maybe that's just a fluke in the data. I also don't understand why this one's growing so much. Someone asked me about this a while back, and I just didn't really I didn't know what exactly was going on. So I'm going to put this in the too hard category. Unless a person really did the deep research, figured out whether this recent earnings pattern was actually sustainable or not. I think I did look into it, and they bought a lot of smaller distributors, or what, I forget if that's the name that they use for the bottlers. Bottlers, what I was thinking. I want to say they bought a lot of the smaller bottlers, and that helped lead to this. So I don't know if they can keep doing that and if that's sustainable. That'd be my big question to answer. So for now, it goes in the too hard category. But that is one I did spend some time actually investigating, trying to figure out what the heck was going on. Columbia Banking Systems. I don't know if that's actually in Columbia. So these guys got hit very hard during the financial crisis, but did recover. And now earnings are coming down. The market's treating it pretty sketchily. I would say this one is just going to be too hard for me. Columbia Sportswear, COLM. I have looked at this one in the past. I haven't looked at it recently. Yeah, so this would be kind of a normal deep cyclical. They had a pretty deep decline during the Great Recession, COVID, we can kind of ignore that to some degree. But now we see this new kind of retail decline happening after a pretty good run. So, you know, I would put this one in the deep cyclical category. But usually I do limit the amount of like apparel retailers. They're just so hard. Consumer behavior and consumer, you know, trends are very hard to kind of, they can change a lot. So it makes it difficult to make long-term. You would probably want to wait for, if you have like a downturn, you really want to wait for the upturn to start again to prove that they're going to come out of it. So that'd probably be the approach that I would take with Cody. Yeah, I would say this just doesn't have enough data in their current form. I think they own a bunch of luxury brands. Yeah, I'm almost positive. Okay, let's see. Capri, I think Capri is actually kind of the same thing. CPRI. Could be wrong about that. I'll double check. Yeah. This is a cross between not enough data and not high enough quality. Really, it's not high enough quality. Earnings, if you just look at the earnings pattern, once they got up here, they haven't even really quite been able to sustain that, and the stock prices suffered the whole time. So you'd have to have some reason to believe that they could pick things back up again, and I'm not smart enough to do that. So, okay, Crane. Maybe. There we go. Okay, not enough data. Maybe those guys spun off or something. I thought they were around longer than that. Carter's. So this is probably going to be not high enough quality, because I think this is clothes again. Yeah. Actually, it looks pretty good here, but the problem is this trend that we see right here. You know, if you go back 10 years and the stock price hasn't gone anywhere, and earnings and everything are beginning to kind of level off, they probably have kind of got as big as they can get without some kind of new catalyst. So I would say they're just not quite, even though up until now, this period, they had enough quality, it looks like they're struggling now. So this trend is probably kind of turning over. I bet if I looked at the 3-year revenue trend, it would be negative, and that would be enough to keep me out of it for quality reasons. Crocs, this is another one that's going to be kind of unpredictable because it goes through kind of popularity trends. If you can get the bottom of the beginning of a new trend, like I remember I was down in like the Virgin Islands back in 2007, and everybody on like the yachts and the catamarans were wearing Crocs, and you can see that if you picked up on that trend, it was like, you know, like right in the middle of the winter of 2007 at some point, and you bought the stock there, you know, it wouldn't have recovered until, you know, like 20 years later or something like that, or 10, I guess that's 10 years later. But now we have this new uptrend going, but it's just really hard to know when this, you know, turns around or not. So this would be in my too hard category for sure. I'm not a retail trends person, but if a person focused on that, I mean, they could maybe predict, because you have to get the beginning and the end of the trend right, and doing both of those consistently is really hard. So this is a pretty choppy one. What do these guys do? Oh, semiconductor. Okay, so this would be a deep cyclical. The real question would be, is there enough to make money on it? Yeah, I mean, there is. Yeah, I would treat this as a deep cyclical and take a look at it. There are a lot of semiconductor businesses. So if you can buy them during the down cycles, sometimes they move together. So I try to choose the best ones usually, but that one seems like it's worth tracking. CSL. Okay, so these guys are building products. Okay, so this is not the financial company. Yeah, this is going to be too hard because these guys have big down cycles. They can be hard to predict. They're in the middle of a big upcycle now. I just think this is too hard for me to predict, and you can't really see it on this fast graph when it's this big. but stock fell, over 60% during the Great Recession, probably much deeper than that, actually. I'm just picking quick dates here. Somebody could probably do something with this, but it's just too hard for me, so I'd put it in the too hard category. Let's see. CubeSmart. This is a REIT. I think I did track that one, so it should be good. And then CUZ, another REIT. See what kind of history we have here. So again, this history just is not high enough quality for me. For a REIT, I want to see a good, solid uptrend for most of the time. Let's see. Commvault, CV. We're almost to the end. CVLT. Haven't heard of these guys before, I don't think. See, this is just... What do these guys do? Okay, software. All right. You'd probably want to do a little bit closer research. Let's see what their growth rate is here. Yeah, I mean, this one maybe. I'd have to look and see exactly what their software does and how cyclical it might be. It might be one of those where you could buy during one of these kind of pullbacks. But I would want to look into it a little bit more. But I would definitely be interested in examining it a little bit closer. Okay, Curtiss-Wright, CW. Here we go. I know I've tracked these guys before. Yeah, they're going to be fine for full cycle. I think I even owned it for a little while, but I don't anymore, which is too bad. I probably sold like right before it went, kind of got really overvalued. It happens sometimes. CXT. So that looks okay. I'm not sure what's going on with this expected. Let's see what they do real quick. So electronic equipment, I would put this in the deep cyclical category and examine it as a potential, because look, it has the stock price does tend to fall a lot. That can create opportunities, but I would only be buying it during down cycles. So I think a deep cyclical would probably work for that one. CYTK, and that's the last one. Cytokinetics. I wonder if these are biotech. Yep. So biotechs don't usually fit very good unless they're earning money. So this one's going to go in the too hard category. Okay, I think that's it. Now, if I didn't miss any, I think when I counted through these, there was maybe like 46 or 47. So in terms of those that fit in the full cycle category, I had 14. So about a third of them. That seems pretty normal to me. There were 6 deep cyclicals out of those 46. So, a little more than like 10, maybe 15% or so. One growth stock, which I think was Celsius, and one REIT, no dividends. So about 40%, we'll call it, of the, let's see, 10, 20. Yeah, about 40 to 45% of these would be worth kind of doing more research, tracking, using my strategies. We had another 14 that didn't have enough data, 10 that weren't high enough quality, and another 14 that were just too hard. So kind of equal parts, pretty much equal parts among the 3 kind of categories that I don't, of the reasons that I wouldn't kind of move much further with those. So I think this is, pretty standard for like mid caps, for like a decent quality mid caps. I would expect actually as time goes on to get more growth stocks. Let me see how many, if I have it down here. So last time I didn't have any growth. Okay, in the A section. So yeah, I would expect to pick up a few more kind of growth stocks that look good for my growth strategy. as time goes on, I've only had one, and we're through like probably 100 stocks out of the Midcap 400. So hopefully that kind of helped just show you how I initially look through things. After things go kind of in the categories that I might want, I look closer at them. Probably a few more would get eliminated, and then I put the rest in the spreadsheet that you guys see me use, and I would track those. Now sometimes if it looks like it's a semiconductor or a bank or an electronic component maker, usually what I do is I just try to track the ones I think are the best, if there's like a whole bunch of them that trade similarly. So that's another kind of thing, because there's a lot of times certain stocks will trade similarly. And so if that's the case, then I just kind of try to track the ones that are the best and buy the ones that are best. But other than that, I mean, I think the stats are kind of working out how I probably would have expected them to. And I'll keep doing like one of these a month, and we'll go from there. And if you think Fast Graphs would be a good software tool for you guys to try out, that 25% off link is down in the description. All right, if you found this useful, hit the subscribe button, and then I have a playlist I'm going to put this on with, and over time, I'll fill out the whole Midcap 400. Thanks for watching. I'll see everybody later. Bye.